Mistry is with us, co-founder at Buoyant Capital. Jigar, good to have you here. Thank you for your time. You know, we've seen this. It's not new, right? Every once in a while, we do see. It does seem like the world is ending, but the world rarely ends. It goes on. That's a slightly high-level philosophical take on the situation, Jigar. But what is your sense, though? Realistically, pragmatically, markets corrected. Broader markets are seeing a fair bit of pain. 5% earnings growth for the Nifty in FY25, and then maybe 12-13% for 26. Those are consensus expectations. The budget is around the corner, so there are potential triggers. Will they actually turn out to be triggers? We don't know. What's your sense?
Hi, Prashant. First of all, thank you as always for inviting me on the show. I would like to believe that a lot of red brings in the philosopher in you, so I'm with you as far as all the philosophical debate goes. But I think, see, if you take a slightly higher level view, then essentially take a 5 or a 10-year rolling return, EPS growth and the share price growth or index level growth across indices, across stocks have always aligned. Today, the large cap is roughly 2 times the returns on the EPS, and the small cap returns are roughly 3 times that of the earnings. If in the longer term they have always aligned, then the fundamental argument has to be that we see the earnings increasing above trend in a material way, or the share prices have to correct. We don't see sort of earnings going up in a hurry, Prashant, because if you look at what's been driving that, which is the capital spending, we are seeing a significant slowdown therein. Right? Consumption of the bottom 40% household has not risen in many years. So the government's way of looking at or tackling this growth problem was to keep spending its way in the hope that they'll crowd in the private sector. In that process, private sector capex has become a lot more responsible after 2015 when the IBC and the other laws were introduced. And the states which were spending, so we did this analysis over the past sort of 12 elections, the state freebie budget, for the lack of a better word, is very similar to its capex budget. So, consumption is not happening in a hurry. Capex used to drive it, but that's slowing down. And share prices have risen way ahead of fundamentals. And therefore, sort of, if we can't argue that the EPS should increase, then the fundamental call has to be that the share prices will correct. How long do they go is a question of debate, but I think directionally we are completely aligned to what the market is pointing at this juncture.
And this whole narrative that liquidity will override and mask weak fundamentals, you don't think that is going to hold in 2025? What makes you say that?
Hi, Reema. So see, you take sort of, say, 2014, the household savings coming into equities was 0.4%. Today, even at a 3 lakh crore inflow, it is just 4%. I know it for a fact that at the peak of the markets in 1992, that number was hovering around 15%. So today, I can make this argument that 2 years out, your sort of nominal GDP will grow, household savings will grow. And even if we approach 10% of that savings coming into equities, then the mutual fund flows can even triple from here. So we're talking of a number of around 9 to 10 lakh crores. My argument against that line of thought is that, we have had multiple narratives over the past 20 odd years. So in early 2000, it was the dot-com sort of, pets.com raising $182 million. There are companies that were valued at $10 and $100 billion, which effectively went down to zero. 2007 to 9, we had real estate companies in India becoming the largest market cap and richest Indian respectively. 14 to 19, there was this consumption narrative. But despite that, whenever you look at a 10-year rolling return, the EPS growth and the rolling returns have always aligned. Right. So despite whatever narrative, the fundamental fact remains that if we can argue that free cash flows and earnings of an index of a market can rise, only then can we start building in this sort of growth. See, remember, 50% of the mutual fund investors today have come post-COVID. So they've not really seen a 20% drawdown. And how they react in this cycle will determine sort of how deep this cut is what my sense is.
Hi, Jigar. Yes, absolutely. Take your point. Until now, they have been absolutely resilient. They have not wavered. They have not shifted. And that's what the last data tells us, right? The December numbers that we had, where equity funds still got over 41,000 crores of rupees. But yes, I mean, that faith can be put to test, especially for newer investors who have come into the market after COVID. So take your point completely. But let's look at what we can take action on and what we can control. So while the global backdrop settles and the dollar index and tariffs and all those issues are way beyond us, let's talk about maybe some pockets or examples, if you can name stocks, where you seem to have clear earnings visibility. At least for the next several quarters, there is clear earning visibility, and you're seeing valuations come back into a little more sane zone.
Right, Surabhi. So I think on your point, right? So just before I answer your question, if I have a minute of sort of a latitude, then I'll say that, if you are an investor in the early 2000s, you would have seen close to 6,000 trading days, of which sort of top 10 trading days, which is 0.2% of the number of days, have accounted for 60% of the returns, right? And top 25 days have accounted for 84% of all returns. So investors who, would like to believe that, oh, I'm sitting on the largest cash position of our lifetimes, I feel the conundrum that you would have been sitting on that for a year now and you would have been right theoretically, but you would have lost money. And therefore, adjusting portfolio beta instead of very large cash call is, I think, the way sort of one can go ahead with this. The last time when I was on your show, about a month and a half back, I would say, we said that if you look at the fundamental dislocation between earnings growth and share price growth, 2 or 3 sectors clearly stand out. Within them, financials is top of the line. They have been sort of a victim of flows, the same way small caps have been a beneficiary of it. FIs could only sell what they owned, and they sold a lot of these financials, and therefore you are getting financials index growth much lower than earnings growth, and accounting for sort of margin squeezing up, NIMs lowering, some asset quality troubles. That index is still, I think, in the prime of health. And therefore, that's sort of one pocket which we find very interesting. The second is also healthcare, right? Healthcare, we have argued early 2023 that sort of generics, volumes, and pricing seem to have seen the worst behind, and things could continue to improve thereon. There's a few pockets of stocks that we like, in the small cap space. But I would still say, our small cap exposure is towards the lower end. 2023, we were predominantly exposed to small and mid caps. Today, that number is much lower.
Points taken, Jigar, and very good points that you make. Let's hope that. By the way, just to come back to that first point, how much do stock prices have to fall to align with long-term EPS growth? Long-term returns are about 12%, 25 years, rupee terms. What's
right.
What are we looking at?
So rolling returns, Prashant, are 12% earnings growth for Nifty, about 10% earnings growth for small cap. Today, the index is up about 17% for large caps and about 30% for small caps. Small caps, I would say, is better to look at company to companies. But the broader point I was saying is that, so many of us have gotten very used to flows driving the story. And sometimes, most often than not, it doesn't really play out.
All right, Jigar, thank you very much for joining us. Good speaking with you. And, we'll chat again and keep sort of taking stock of things as they continue to play out. Well, we'll take a break. We're back.